When we're discussing the previous topics in macroeconomics, we are assuming that the economy was operating within its own borders or at a domestic state. However, in reality, that is not the case, and it is becoming more apparent that our economy is more open than ever. Globalization has always been a part of our society, so what are its basic concepts? The basic concepts that we must review is that of a closed economy, where the economy does not interact with other economies in the world. By today's standards, this is mostly theoretical because all countries in the world have some type of connection to each other. In other words, they participate in an open economy that interacts freely with other economies around the world through the buying and selling of goods, services, and financial assets, such as stocks and bonds. These transactions are recorded in the nation's balance of payments accounting sheet. The balance of payments sheets reviews a nation's exports and imports and records its net exports. Just a refresher, net exports is when exports are subtracted from imports. The balance of payments sheet also reviews whether a nation has a trade surplus, whether the exports exceed its imports, or a trade deficit when imports exceeds exports. Therefore, the balance of payments is the sum of all the financial transactions that take place between a nation's residents and the residents of other nations. You may see a former or older term on the AP Macro exam as net capital outflow. Therefore, familiarize yourself with both terms. There are two accounts that show these transactions. They are the current account and the financial account. The current account primarily represents the transactions in trade. Since we are in the United States, the focus will primarily be on the U.S., but bear in mind that the AP Macroeconomics exam is an international exam and would want you to approach these concepts with an international view. Under the current account, you have the balance on goods and services, which is the difference between imports and exports of goods and services. So exports show a credit or inflow to the nation, because when firms in the U.S. export goods and services, they receive a payment. However, imports reflect a debit or outflow because when firms in the U.S. import goods and services from other nations, those U.S. firms have to pay those companies. The current account not only includes payments for goods and services, but also investment income. If a business in Mexico buys a wheat farm in the U.S. and earn a profit, then the profit payments will count as a credit to the country of Mexico and a debit to the United States. The current account also includes transfer of money. If an immigrant from Singapore comes and works in the United States and sends their money home to their family in Singapore, that transfer of money would be a credit to Singapore and a debit to the U.S. You must also understand that price levels and real output on the ADAS model impact an economy's current account. For example, if price levels increase, this would make goods in other countries cheaper and domestic goods expensive. This outcome would increase imports, reduce exports, and lead to a reduction in aggregate demand. The other account under the balance of payments is the financial account. You may also see an older term on the AP Macro exam as capital account, so again, please familiarize yourself with both terms. It reflects the payments of international, domestic, and other country assets transactions. The two types of assets that fall under the transactions are physical assets such as factories, office buildings, or other types of real estate. Take note that physical assets are only recorded under the financial account when there is a change in ownership. For example, if a person from Nigeria buys a coffee farm in Ethiopia, the payment for this asset would be counted in the financial account as a credit for Ethiopia and a debit for Nigeria. The second type of assets are financial assets such as stocks, bonds, or time deposits. For example, if an investor from Hong Kong purchases a U.S. savings bond, that payment would count as a credit to the U.S. financial account and a debit in Hong Kong's financial account. Financial accounts are impacted by the equilibrium interest rates in the money market and loanable funds market. Therefore, depending on whether it's in the short run or the long run, the interest rates determine the behavior of investors who are overseas, and they prefer high interest rates because they will receive a higher return.